Well, hello, and welcome to this Tommy talk on pandemics and stock prices. My name's Richard Sloan, and I'm the Accounting Circle Professor of Accounting here at Marshall. My research focuses on how investors use accounting information, and I'd like to talk with you today about some research that I've done on how stock prices responded to the onset of the coronavirus pandemic. I'm going to start off with a graph here showing the average monthly stock return in the months leading up to the onset of the pandemic. And you can see here that stock prices in the year leading up to the pandemic are fairly flat. And then as the pandemic approached and we had the onset of the pandemic, on average, stock prices started to fall. And you can see here that in March of 2020, they fell quite precipitously. Now, what we want to focus on is not just why stock prices fell, but what I'm showing you here in the gray shading is the range, the interquartile range of stock returns in each month. And you can see that that range expanded considerably in March of 2020. That tells us that some stocks went down by a very lot, but other stocks didn't fall by much at all or even went up. And so what was really notable about the onset of the pandemic was the increase in the volatility or the cross-sectional variation in stock returns. And that's what we're going to focus on. Now, I think it's clear why stock prices should fall in response to a pandemic. I've got a quote here from a well-known investor, a hedge fund investor called Bill Ackman, and he's quoted here in the middle of March of 2020 saying that the shutdown is inevitable. And obviously when we shut down our businesses, sales stop, profits stop, cash flows stop, and value is lost. And I just want to read a more detailed quote that he made in his letter to shareholders a couple of weeks later. The revenues and earnings for the majority of businesses over the next year or so will be extremely poor, and in some cases disastrous. But for companies with strong balance sheets, dominant market positions, and which do not need access to capital, the virus will likely only disrupt the next 12 to 24 months of cash flows. In a discounted cash flow valuation, a company, the loss or disruption of the first and possibly the second year of cash flows does not generally destroy more than 5 to 10% of the value of the business. So the point here is businesses last for many years, and if all the coronavirus does is basically disrupt the first 2 years, we'll still have the cash flows from all the subsequent years. Effectively, it'll be a disaster, but it'll be a disaster followed by a quick recovery, and when we get back to normal, we'll get back to receiving those cash flows again. And if we only use the first year or two of cash flows, that should only wipe out about 5 to 10% of the value of a typical equity. Now, what we want to focus on here is that might be true for the typical equity, but stocks should respond differently. And in particular, if you think about it, some stocks are stocks that we like to term harvesters. These are stocks that are essentially late in their life cycle, and they're expected to generate a lot of cash in the near future, but not in the distant future. You can think of bricks and mortar retail. You can think of energy companies with big fossil fuel reserves. These are businesses that have done well in the past, have got lots of cash flows today, but we don't expect they're going to have so many cash flows in the future. Other stocks we call growth stocks, and these are stocks that don't generate a lot of cash flows today, but are expected to generate a lot of cash flows in the distant future. You can think of many tech stocks. You can think, for example, of a biotech startup company that's developing a new drug but doesn't expect to sell it for the next year or two. And a stock we're going to focus on in this category later on in the talk is Tesla, the electronic automotive company. Now, what I hope you can see here, if the pandemic basically only affects cash flows or primarily affects cash flows in the next year or two, it's going to have a big impact on the harvesters because we're really banking on and valuing those cash flows in the next year or two for those stocks. But for the growth stocks, we never expected to get much cash flow from them in the next year or two anyway. And so as long as they survive and they generate cash flows out in the distant future, they should lose relatively little of their value. But how do we separate the harvesters from the growth stocks? Well, it turns out I'd done a paper on just this topic many years ago, in fact in 2004. It was called Implied Equity Duration, a New Measure of Equity Risk, and it was with two other authors, Patricia Desho and Mark Solomon. I was at the University of Michigan back then, so was Patricia Desho, and Mark Solomon was at the Stanford Graduate School of Business. It turns out, right now, all three of us are at the Marshall School, and so we saw the applicability of this measure we'd developed to the pandemic and decided to get back together and do our research. And I'm not going to talk about that paper in detail, but I want to give you a little bit of intuition about duration and how you apply it to equities. Duration is a common measure in this analysis of fixed income securities, and what was unique about our paper was coming up with an algorithm to compute duration for equities. So I'm going to use some very simple examples to illustrate the concept of duration. And in example 1 here, this is what we call the benchmark case. We've got a company that's going to generate $3 of cash flow a year for the next 5 years. So the total cash flow we're going to receive is $15. And this is a level stream of cash flows, and the duration for this stream of cash flows here is going to be 3 years. That means that on average, we have to wait 3 years to get our cash flows. And you can see, right, 3's right in the middle there. So I think the intuition's clear. Now, what would happen if a pandemic came along and wiped out the first 2 years of cash flows for this company? Okay, if those 2 years worth of cash flows are gone, we've lost 3 plus 3 equals 6 of our cash flows. 6 on 15 is 40%. So the value of the business, if you like, has declined by 40%. I'm ignoring discount rates here, I should mention, just to keep things simple. Now, next up in my example 2, I'm going to look at an example of a harvester. In this case, the total cash flows are still 15, but remember, for harvesters, they get most of their cash flows early on, and the cash flows are expected to decline in the future. So we've built that pattern in here. We start at 5 and we decline gradually down to 1. Now, if you computed the duration for this stock, it would be 2.3 years. On average, we have to wait 2.3 years to get our cash flows. But if a pandemic comes along and wipes out the first 2 years, what's basically happened here is we've lost $9 worth of cash flows out of 15, so we've gone down by 60%. Remember, it was only 40% for the benchmark example with 3 years duration. So as duration goes lower, more of the cash flows come early on and we lose more of our value. In example number 3, we're going to focus on a growth stock. And remember, for growth stock, cash flows start off low but are expected to grow in the future. So here again, we've got $15 worth of cash flows total, but they start off at 1 and gradually climb to 5. What happens if a pandemic comes along here and wipes out the first 2 years of cash flows? Well, we've only lost $3 worth of cash flows, and 3 out of 15 is 20%. So we've only lost 20% of our values. So for a high duration equity, we're going to lose relatively little of our value. Okay? So they're very simple examples. Let's take a look at some real-world examples that we got from applying our algorithm. Well, the 2 stocks that we're going to look at of examples from the real world here are both from the automotive industry. The first one is a good example of a harvester, and that's GM, or General Motors. And you can see here that the implied equity duration, which was computed as of the end of 2019, before the pandemic, was 17.1 years. And you can also see in the graph here the classic harvester profile, where the cash flows start high and then trend down later on. And GM has had a long and storied history, though in recent years its sales and market share have both been declining. So it fits the profile of a harvester stock. And you can see here with the very high cash flows being forecast for the next couple of years, when the pandemic hit and we curtail those next 2 years of cash flows, a fairly large proportion of GM's value is lost. And indeed, over the first quarter of 2020, we'll see that while the S&P 500 fell by 20%, GM lost 43% of its value, low duration, and a large decline in value. At the other extreme, an example of a growth stock in the automotive industry, we have Tesla, and the implied duration there was 32 years. And here you can see the classic growth stock cash flow profile with the cash flow starting low, in fact slightly negative here, and then increasing later on. And you can see there's a fairly sharp increase starting in 2035 here. That has to do with the way our algorithm works, and that's where what we call the terminal period starts. But you get the idea here that Tesla's not expected to generate much cash flow in the near future. It has a very high stock price, and so investors must expect large cash flows in the distant future, and that's what our algorithm is telling us. Now, I should point out here that Tesla is a controversial stock, and some people think the stock price is just too high. Many professional investors have commented on that. What I think we can all agree on here is that Tesla's stock price is certainly not going to be justified by cash flows that are generated in the next year or two. It's a long-term growth play, and its expectations of long-term future cash flows that is driving its valuation. So when the pandemic hit, it's going to curtail their sales and cash flows for the next year or two, but since they were always a small proportion of the total expected cash flows, it should have relatively little impact on Tesla's value. And indeed, what we saw here was that while the S&P 500 fell 20% in Q1, Tesla didn't go down nearly as much. In fact, it actually went up by 25%. And that looks a little surprising there to see it go up. And we'll come back to that later on as to why Tesla might have actually gone up during the onset of the pandemic. Well, here we've just looked at two examples. What we're going to do next is we're going to look at the relationship between duration and stock returns at the onset of the pandemic for all stocks in the US that traded on a major stock exchange. And you can see that in this graph here. What we did is we divided all the stocks into 5 groups based on their duration. And the lowest group was the low duration 20% of stocks, and the highest group was the highest duration 20% of stocks. And then we tracked their stock returns through the onset of the pandemic, from January the 2nd through March the 31st. And the first group here, the bottom line, they're the 20% of securities or stocks with the lowest duration, and they went down by 40%. On the other hand, the top 20% of stocks in the high duration portfolio as a group only went down by 8%. And you'll remember that the S&P 500 fell by about 20%. So what you can see is this single measure duration's been very effective in picking out which stocks have gone down by a lot and which stocks have only gone down by a little bit. So it's very helpful for understanding how pandemics impact stock prices. Now, I want to show you one other insight that we got from this paper before I wrap up here, and that relates to value stocks. Many of you may have heard value stocks discussed in the media. A lot of investors like to invest in value stocks because they think they're going to outperform the market. And it turns out, unfortunately, at the onset of the pandemic, value stocks did very badly. They were amongst the worst performing stocks. And I just want to show you how this relates to duration and understanding why they did badly. Now, when investors pick value stocks, they often pick them on measures like price to earnings and market to book ratios. And I'm showing those on the graph here. And you can see that the value stocks are going to be those that are in the bottom left of the graph. Low price to earnings and low market to book ratios. They look cheap relative to current fundamentals. Okay. Now, another interpretation is that these stocks aren't actually cheap. They're simply stocks for which current fundamentals are high and are going to go down in the future. They're harvesters. Okay. So rather than being cheap stocks, they are really low duration stocks. Okay. And the color coding here, the burgundy, the deeper the burgundy goes there, the longer the duration. And what you can see here is that the value stocks are the low duration stocks and the growth stocks are the high duration stocks. So if you want to know why value stocks dropped a lot at the onset of the pandemic, it's the very same theory that we just talked about here. It's their low duration and the fact that they tend to be harvesters that were promising a lot of their cash flows in the near future. And it turns out, as we show here, the value stocks as a group tended to have much lower stock returns at the onset of the pandemic. And we've grouped them by industry here just to show you a limited set of points. So the key takeaway here is that value stocks have underperformed at the onset of pandemic. And that's not because they're just getting even cheaper. It's rather because they're low duration stocks, and low duration stocks are affected more by the onset of a pandemic. Well, before we wrap up here, I just want to close by talking about some additional considerations. The first one relates to discount rates. The onset of the pandemic has also been accompanied by a significant reduction in discount rates or interest rates. Central banks around the world have lowered interest rates. This makes stocks more valuable because when we use a lower discount rate, the present value of the future cash flows is higher. But this effect is particularly magnified for high duration stocks because their cash flows will way in the future and we're going to be more heavily discounted using a higher discount rate. So we saw earlier that Tesla actually went up at the onset of the pandemic, And one possible explanation for that is because their cash flows were expected to be received in the distant future, and because discount rate went down, the present value of those cash flows went up. The other point that I want to mention here is we're looking at duration here as just one factor that affects stock values during pandemics. There are many other factors, and this one measure is no silver bullet. It's just one of many things to look at. Some of the other things you obviously want to look at here is whether the stock operates in an essential business versus a non-essential business that's more likely to get shut down, whether the company involves in-person versus online transactions, obviously online transactions being less affected, and also whether the company has high financial or operating leverage. Companies with high leverage are less able to withstand short-term disruptions to their cash flows. Well, just before I wrap up here, if you want to read more about this topic, I just want to point out that there's some additional resources we're providing access to. First off, there's a paper that details the research that I've summarized in this talk, and we'll provide a link to that. Then there's our original paper on implied equity duration where we develop the measure, and we'll also give you a link to that. And finally, we've made a spreadsheet available if you'd like to compute implied equity duration for a stock of your own. Well, that's all I have for you today. I do hope you enjoyed the talk, and I hope that you stay well both physically and financially, and fight on.